Hello, everyone. Welcome to our discussion of Chapter 1 and our introduction to what we're going to learn this semester in income tax accounting class. So, first of all, we are going to talk about income taxes at the federal level, the United States level. There are state income tax rules that we will not have the ability to go over, as they are different in almost every state in the United States. Many are based on the rules for the federal, so it's a good starting point, but there are specific things to each state. Also, what we're not going to look at is other forms of taxes, like sales taxes, excise taxes, duties, all kinds of other things. We are focused on the federal income tax. And so a little history. We first had an income tax. It's not always been the case. In fact, for many years, it was considered unconstitutional to have an income tax based on the way that it described taxes in the Constitution. Despite that, the income tax was enacted kind of as an emergency measure during the Civil War, went away, passed again in 1894. Supreme Court said, no, doesn't fit the Constitution. So we amended the Constitution in 1913 to allow for direct taxation of individuals and their income. Prior to that, the basic idea was if you wanted taxation, it had to be on commerce, so you could have tariffs and things like that, but you couldn't base it on people. And so constitutional amendment allowed that to happen, and so we have the first income tax law there in 1913, and it's changed and morphed. The latest truly big overhaul, and what we're referring to now, is in 1986. Today, or at least as of 2019, we get a report. It's usually a couple years delayed from the IRS. The IRS is so far behind right now that our next one will probably be even more behind, further distanced. But in 2019, there were 158 million individual income tax returns. So I just want you to kind of let that sink in for a minute. Think about how many of that there are to do, and why we need rules and standardization about how to treat things. Because if everybody followed a different set of rules, it would be chaos and it would be very inefficient. So it's about generating revenue for the government, for the federal government. It's also about getting people to do certain things that the government thinks are good things. Okay, we'll find that over and over again in our tax law, that things that the government feels like you should do will have tax benefits, and things that you shouldn't do will have no tax benefit, or maybe even a tax penalty. All right, so 158 million. Today, most of them are filed electronically. By far and away, most of them, 94%. All right, and of course, the government or the IRS would prefer that they all be filed electronically, but there are still a few things in the tax law that can't be. If you have that, you can't file electronically, but that's pretty rare. There are still a few folks that insist on doing it with paper, but it is so much more accurate in everything with electronic filing. Okay, that resulted in collections of tax just over $1.5 trillion. Okay, in 2019. So we're talking about a lot of money. We're talking about a lot of returns. We're talking about a situation that is fairly complex. And that is going to make our life a little bit more difficult going forward, but that explains some of the complexity that we will have to deal with. All right, so how do we calculate tax, and a little bit about the different ways that we might do that, okay? Taxes are levied by multiplying a tax rate by the tax base. So a percentage that you need to pay, a percentage of your income times the amount of income, okay? Now, what we could have is multiple rates on multiple tax bases, meaning you could have different tax rates for different levels of income. That refers to a progressive tax structure where the tax rate increases as the tax base increases. That's how our system works. So here I have gone to the IRS website, official, and where they gave us the tax rates for 2021 for they've given it to us together, single and married couples filing jointly. So as you see, the rate is different depending on your income. So what has to happen and how we calculate the tax rate, how much your tax liability is, for instance, your income first $9,950 is taxed at 12%. So you break your income into sections, and the first $9,950 of your income, you pay 12% of that. And then you take the next, so between $99,000 and $40,000, the next $31,000, and you pay, it's 10% for under $9,950, and 12% for $9,950 up to $40,000. So there's a section of income. And then there's another section of income from 40 up to 86. That you pay 22% of that. So literally you cannot take just your whole income and multiply it by a percentage. You have to take each section of income, all right, unless your income is $5,000, and then you can just take 10% because it is below the lowest rate, all right? So that's a progressive tax structure. There are different tax rates. But the thing to remember is the first $9,000, even if your income is $1 million, your first $9,950 of your income is still taxed at 10%. And then there's still a section that is at 12%. So that's how that plays out. So alternatives to a progressive proportional tax structure that we want to talk about is no matter what your income is, you pay the same percentage. So you're familiar with your local sales tax. It's 6% in Pennsylvania on what you buy, regardless of how much you buy. Okay? So that's a proportional tax structure. And a regressive tax structure is where the tax rate actually decreases. So if we had a regressive tax situation, you would have seen the tax income level go up, and then the rate of tax would actually go down instead of up like it did in ours. We have the Social Security tax system where you pay one rate up to a certain amount, and then a different rate once you reach that amount. And so it is somewhat regressive. So to understand how income taxes help people make decisions, we want to talk about the average tax rate versus the marginal tax rate. So imagine average tax rate is simply when you have calculated, when you have figured out the tax liability you need to pay, you simply take that amount and divide it by your income or your taxable income, and that's your tax rate. Okay? So if your income is, say, $80,000, it's going to be an average between the 10% part of your income is going to be at 10%, part of it at 12%, okay, part of it at 22%, okay. It'll be kind of an average of those. It'll probably be a decimal. It's not going to be a nice round number, okay, but it'll be an average of those. Marginal tax rate is the rate you're going to pay for the next dollar of income. So when you are the rates we were looking at earlier, okay, if your income is in between the 12%, let's say, tax bracket, anything between that 9,950 and up to the 40,000, okay, your marginal tax rate would be 12%. If you make one more dollar of income, you'll pay 12% of that in taxes. That's what your marginal rate is. It's what you will pay on another dollar. So it will always be a round number. It will not be a decimal or an average, because it is going to simply be where do you fall on the tax brackets. Okay? And that is what most people believe is what causes people to make decisions. They make their decisions not on their average tax bracket, but on their marginal tax bracket. What if I make a decision and make more money? And I get asked this question all the time, how much will I have to pay of it in taxes? And that's your marginal tax rate. Okay? So, and it depends on how much your other income is, right? It depends on where you are on those tax brackets. So this formula on the slide here is the key of all we do. This is what a tax return is going to actually calculate. Okay, this is what we need to learn. All we're going to do with this formula is just make it increasingly complicated by adding things to the various things. The formula, the process isn't going to change. But what we're going to add to is a whole lot of detail to each of the pieces. So you start with income. Income is everything that from any source derived. Basically, if it makes you better off, it's income. And only if the law says it's not, can you leave it off, okay? And then you have deductions from income, and those are only permitted in the tax law. So income is everything. Deductions are what the law says they are, equals your taxable income. You then find your tax liability by applying the appropriate tax rates, either using the table or whatever tool you use, get your tax liability, and then that's what you owe. But you may have made earlier payments, you may have tax credits because of what you spent money on, that they allow money that the government allows money that you spent on something else to apply to your taxes. So you get a credit, meaning you don't have as much liability, and then we work it out, and the ultimate goal of the tax form that we file each April is to work out what we owe versus what we paid. It's really a reconciliation. This is all my income. This is where it all came from. This is what deductions I'm entitled to. This is how much I already paid. This is the credits I have, and this is what I end up with. And if you paid more than you owe, then you get a refund. And if you put in less than you owe, then you're going to have to make a payment with that tax return. So we file a tax return using Form 1040. Okay, there's some schedules 1 through 6. Some people will use all of them, some will use one of them, some will use none of them. Okay, depending on how complicated your income sources and deductions are. Okay, they are all part of this basic tax formula. They all support calculating one of those steps in our tax formula. So this is a PDF version of the 1040 for 2021. Information at the top about the taxpayer, people involved, all right, that sort of thing. And then, as we talked about, it supports that tax formula. You start to list your income. And when you get to like line 8, other income from Schedule 1, that's one of those schedules, 1 through 6, where you may have income that's not listed here, but that we want to have the detail for in a separate schedule. And you add that schedule up, and then it gets reported on the 1040 here. So then once you've got your total income, then you make adjustments. And again, that comes from a schedule. Adjustments are another way of talking about deductions. We'll get into later in chapter 3 and 4. All right, standard deduction is the one deduction we're going to talk about in chapter 1. We're going to treat it as if it is the only permitted deduction for now. All right, you finally get your taxable income, and then you figure your taxes, and we'll talk about how that's done, your tax liability. Then all of the rest of this stuff is credits, payments that you made, credits that you're entitled to, and you ultimately come down and compare how much you've paid in, how much your credits are versus the amounts you actually owed, your liability that you started with back up here on line 16. And then you tell the government to either take it out of your check, you'll send them a check, or to send a refund. And then you sign it saying, hey, I'm not making this up. So back to our slides, talking about income, wages, salaries, tips, commissions. Typically, you're going to get some reporting from your employer that says how much you were paid. W-2 is the most common. Okay, that income is going to be reported as we saw on the 1040. You'll get that form. It'll tell you exactly what you were paid for the year, that sort of thing. Okay, that other forms of income that you get from an employer would also come there on that W-2. Interest income that you got from the bank or from someone paying you a loan, you will get as another form from that bank or that institution showing how much interest you were paid. It's called the 1099 INT. Okay, so that's what all this tax reporting, important pieces, so it helps with us filling out the 1040. All right, and you can see some examples of all of these in the textbook. Unemployment, 1099G for government, because that's the unemployment comes from the government. Okay, and then for now, on line 12 of the 1040, we're gonna only deal with the only permitted deduction we're gonna use. We're gonna take our total income. We're gonna subtract the standard deduction, okay? And it's going to depend on whether you're single or married for now, okay? And it's just one of those two amounts, and subtract that and get your taxable income. Now we'll come back and multiple other chapters to talk about other permitted deductions, but for now, this is the one that we're going to use as an example as a permitted deduction. Okay? Once you have your taxable income, then you can calculate the tax. And there's two ways to do it. Okay? One is if your taxable income is up to $100,000, you are supposed to use the tax table. That has been provided in your textbook. Okay? In the instructions for 1040, you can find lots of different ways. Okay? But it is literally, you look up your taxable income, you look up your filing status, and it tells you the tax liability that you owe. Okay? You don't have to worry about what tax bracket or all of the other calculations. It is to make your life easier. You just got to look it up on the table. If your income is over $100,000, you are to use tax rate schedules, which means you have to use this mathematical formula to calculate the tax on your income for each section of income, okay, and applying the different rates. So that's what tax rate schedules are. Now, you might notice that if you do the tax table, okay, for $80,000 of income, and you do the tax rate schedule for $80,000 of income, you may come up with a slightly different answer because of the rounding and because of the idea of the midpoint, okay? Not to worry, you should just be aware that it may come up different. You'll have a homework problem where you'll do it both ways, and it will be like $1 different. Okay? That's to be expected, and just to understand that. Okay? So, what about your tax payments? Well, most of the time the government doesn't wait, right, for their money. For those with wages who work for an employer, okay, they're getting paid, and the employer's taking money out of their checks in order to pay their income taxes. And so that employer has an obligation to send that into the IRS, okay? That's reported on the W-2 how much that was. So that would be a tax payment. All right? We also have other credits. One of them mentioned here is earned income credit. Okay? We're going to get into a whole bunch of those in Chapter 9. Okay? And as we mentioned earlier, we settle up on our tax return. Okay? So, one credit that we want to talk about maybe in a little more detail, get you ready for, kind of as an example. It also is a great example of how the tax law keeps changing. There was a CARES Act passed right as the pandemic started that gave credits to people for 2020. That all worked out in the 2020 tax return. Okay. There was a follow-up law in March of 2021 called the American Rescue Act that provided a credit of $1,400 per person, including any dependents, regardless of their age. Okay, so if you had a Social Security number, okay, and it reported on a tax return at sometime in 2019 or 2020, then they sent you the $1,400. Okay, if you file electronically, they send it to the electronic place that you used. If you filed paper and didn't have it deposited electronically, they would send it to you as a paper check. Okay, they wanted it to go quickly. Okay, out to people to help with the pandemic, but they didn't want it to go to everybody. They wanted it to go to people who ostensibly needed it, so they put a limit. If your AGI is less than 75,000, if you're single, 150 if you're filing jointly, and 112,500 if you're head of household, then you got the full 1,400. Okay? If your income was between 75 and 80, if you're single, you got part of it, and if it was over 80, you should have got none of it. Okay? And the same thing, there's a different levels for each filing status. It's phased out proportionally. So, for instance, between 75 and 80, if your income is 76, then because that's 20% higher, or it's 20% of that gap. The gap between 75 and 80 is 5,000. If you're 1,000 into that, that's 1 out of 5, or 1/5, or 20% of that gap you're into. You lose 20% of your tax credit. So 1,400 minus 20% of 1,400. And if you are halfway through, if you're 77,500, halfway between 75 and 80, you would have gotten half the credit. And if you're, that's what we mean by proportionally. Now, it was to be based on 2021 income, but we don't know what that was. So at the end of on the 2021 returns that we're going to be talking about this year, that will all reconcile. We'll look at the income for 2021. We'll compare it to how much credit you should have gotten versus how much you did based on your 2020 income, if there was a difference. Okay, and you may get more or less, not less. You don't have to pay it back if you got too much. So if your income was lower in 2020 or 2019 and it's higher now in 2021 such that you're over the threshold and you shouldn't have gotten any credit, you don't have to write the government a check. All right. So that is our review of the tax formula, the 1040, how that looks, and what we can expect. The next section will just discuss where we find the tax laws and how we can go about looking up the rules having to do with the tax law.